Hello, everyone. Thank you all for joining us today for our Establishing an Effective Third-Party Risk Management Program for Your Credit Union webinar. My name is Jessie Redmond, and I will be your host. On your screen, you should see multiple widgets that you can use, including Ask Question, Media Player, Slides, Related Content Widget, Speaker Bio, Request Demo, and Help. All the widget boxes are resizable and movable, so feel free to move them around to maximize your screen space. At the bottom of your screen are icon buttons you can use to show and hide those widgets. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner of that widget. If you have any questions during the webcast, you can submit them through the Ask Question widget. Don't worry, we do capture all questions throughout each session. We will be answering some during the webcast, but those that we do not have a chance to answer live, we will address with you via email. For any technical questions, you can use the Help widget, or feel free to submit via the Ask Question widget. Today's live session is eligible for 1 CPE credit. If you wish to receive this credit, please remember to answer all of the polling questions that will appear on your screen during today's presentation. You will also be sent a follow-up survey link 24 hours after the live session that will need to be completed as well in order to receive the CPE credit. With us today, we have Hillary Dewhurst, VinMinder's Head of Third-Party Risk Education and Advocacy. She will be covering third-party risk management program basics and how to effectively manage the risk. You'll see a link to a copy of today's slide deck, a link to our website, links to our third-party risk management lifecycle toolkit, developing your third-party risk management program document checklist, and framework for a successful third-party risk management program ebook, as well as a link to our library of additional resources in the Related Content widget. With all that being said, I would like to hand it over to Hillary. Hillary, the floor is yours.
Well, hello everyone, and welcome to our webinar. My name is Hillary, and today I'll be walking you through a very broad overview, the what, the why, the how, and where of third-party risk management. We're going to touch on the third-party risk management lifecycle a bit, and we're going to talk about the different types of third-party risks you might need to manage as part of your program. We're going to spend some time also talking about reporting to senior management and the board, and then we'll wrap it up with some best practices and some mistakes to avoid. Let's begin with third-party risk management. What is it? Well, first of all, it's good to know that throughout the presentation, you may hear us refer to third parties or vendors, vendor risk management, third-party risk management, or even supplier risk management. It's really all the same, and it's really about managing your vendors and the risks posed by your vendor relationships, because all vendor relationships have at least some risk. Poor performance, cost variation, operational interruptions, those are all vendor risks. When those risks are unidentified or uncontrolled, it really prevents your organization from getting the value of that relationship, and it can result in negative impacts to your credit union operations, your employees, your investors, and most importantly, your members. So why is third-party risk management important? Why does it matter? Well, it's important for many reasons, and it's a best practice. But more than that, when done correctly, it can improve your return on investment and even give you a strategic advantage. It also protects your credit union by first ensuring that you know and have selected vendors, and it improves your cybersecurity profile, because really a chain is only as strong as its link. All your good cybersecurity controls can go out the window if you have a single unchecked or untested vendor who has access to your organization or your members' data. Managing your vendors also can improve service because you're constantly confirming that they have the intended performance and the value of the relationship is continuous. But last but not least, for many industries, including credit unions, it's a regulatory requirement. All right, why is third-party risk management necessary? Well, it's especially necessary now because the never-ending pandemic has opened a huge can of worms when it comes to vendor risk. So not only are we dealing with the vendor risks we've always dealt with, but now those risks are exacerbated, and there are new and emerging risks every day. So for example, cybersecurity crime has significantly increased since the beginning of the pandemic, and ransomware is a huge issue now. We also have a lot of people working remotely, and that brings a lot of cybersecurity threats. Also, many vendors who were financially stable pre-pandemic may not be doing so great now. A lot have closed their doors. And we can't forget all the supply chain issues and the lack of workers. So with all this going on, some industries, including the credit union industry, are facing a lot of regulatory change and increased enforcement. All right, vendor risk management is important and it's necessary, but who's responsible for it, or who should be responsible for it? Let's start with a popular way of breaking this down. You may have heard of something called the 3 lines of defense, but if you've not, it's a fairly simple concept designed to ensure that the board, senior leadership, and all the stakeholders understand their respective roles. So the first line, these are the folks that own the vendor, and so they own the vendor risk also. They may be called different things at your organization, but commonly these are referred to as the vendor owner, the product owner, the vendor manager, etc. They usually fit in the lines of business. The second line are those that oversee and monitor the risk, and they're also the ones that create and maintain those structures, rules, tools, and processes for the first line to use so they can manage their vendors. And finally, there's the third line, or audit. This function must make sure that both the first and second lines are operating effectively and managing the third-party risk and complying with all applicable laws, rules, and regulations. So let's jump into some of these roles and responsibilities. In the first line, let's start with that vendor owner or product owner. This is really where the rubber meets the road, as they say. These are generally the owners, or at least individuals who are responsible for that actual product or service that's being delivered by the vendor. They might be called product owner, business owner, vendor manager. No matter what you call them, they are on point for identifying and managing third-party risk. They're also responsible for establishing and monitoring service level agreements and key performance indicators that are used to then monitor and measure the vendor's performance. And if something's wrong with the vendor performance, these are the individuals responsible for addressing that, creating the mitigation plans, and working directly with the vendor to make sure those issues are closed. They're also responsible for identifying the exit strategy, which determines what will happen if for some reason that vendor becomes no longer viable. So would we move that product or service to another vendor? Will it be brought in-house? Will it be discontinued? These are the folks that have to identify how long those activities would take and what exactly must be done, for example, to move to another vendor. You get the idea. They are responsible for that vendor from onboarding to offboarding and everything in between.
So let's take a look at the second line. When we think about the second line, these are the teams or the individuals that establish the rules, the tools, and the processes that make vendor management possible for the first line. They also monitor the first line work to ensure accuracy, timeliness, and quality. And they facilitate the progression of one vendor management lifecycle stage to another and keep track of what is supposed to happen when. They also work directly with the subject matter experts during due diligence and risk reviews, and they're responsible for reporting to the board, senior management, and any related committees through verbal updates and or presentations in standard reporting. If an auditor or regulator has vendor management in scope, this team will very likely be responsible for gathering documentation and other information for those audits and exams. I want to call out another second line role and responsibility, which are subject matter experts, or SMEs as we call them. SMEs are a vital part of your third-party risk management process. SMEs can be internal or external and are responsible for reviewing and assessing vendor documentation and other information to ensure that the necessary controls are in place and sufficient to manage identified vendor risk. It's important to distinguish that SMEs are highly qualified and have deep subject matter expertise in the risk area that they are reviewing and assessing. They're usually licensed or certified in the risk domains they review. The expertise is the important part here because determining the sufficiency of controls and evidence is often very technical. So this can't really be done effectively without expert knowledge and experience. These folks review the documents, the reports, the network diagrams, workflow, licenses, etc. that are provided by that vendor as evidence of their controls. And this usually happens during due diligence or the risk review. When they've done their review, they should be providing a documented report, providing their qualified and expert opinion regarding those controls. If there are issues, SMEs will often consult with the first and second lanes together, advising on what those insufficient controls are and the potential impacts to the organization. If the vendor is required to remediate any issues, the SME will also need to validate the information that proves the remediation is satisfactory. Now we come to the third line. Essentially, this is audit. Internal audit for most of us, or external if your organization engages outside resources for those services. Their job is to make sure that both the first and the second line are essentially performing their roles effectively, and if they are not, or there are gaps or other issues that must be addressed, their job is to formally write that up, share it with senior leadership and the board when appropriate, and to track that issue until it's closed. It's really important to understand that the third line requires autonomy to be unbiased and independent so they can really tell it like it is. This means providing evaluations on everything from the policy to the execution of the work. Now that we understand the three lines of defense, let's look at three different third-party risk management framework models. Every organization is different, and there are multiple framework models that can be applied to your credit union. So let's go through these. The first one would be a decentralized model. That means third-party risks are shared across multiple departments across the company, and there's really not a specific third-party risk management team. In a centralized model, all third-party tasks are handled by a specific team. This would mean that those first-line responsibilities are handled by that team, as are the second-line responsibilities. Now, in a hybrid model, there is a dedicated third-party risk management team that owns the framework, the third-party risk management framework. They own all the rules, tools, and processes. And they act like air traffic control to coordinate the various tasks across stakeholders and departments. So in a hybrid model, dedicated third-party risk management team working with the vendor owners in the line of business, the SMEs, audit, whoever it may be.
And this brings us to the first poll question of the day. You should see the poll question now in the slides area. If you have any issues, please feel free to send us a message using the Ask Question widget, and we will be happy to assist. Please remember, if you wish to receive the CPE credit for today's session, you must answer all poll questions and be in attendance for the entire live session. This first question is, why does your credit union do vendor management? A, it's a regulatory requirement. B, it improves our bottom line, operations, reputation, etc. C, all of the above. D, we don't currently do vendor management. Or E, not sure. And Hillary, it looks like we have some time right now to answer one of the questions that has come in so far from the audience. And that question is, do you need to do planning at the vendor level or the engagement level?
You know, it's a really good question, and it's a really important answer. So when you are risk assessing, we're really looking at the product or service that's being delivered. What are the risks associated with that product or service? That is really where we're going to identify, do we need access to NPI? Is there a compliance aspect? Even within the same vendor, they may be offering one or more products that may have slightly different risk profiles. So it's always important to risk assess at the product or service or the engagement level versus just the vendor level.
Thanks everyone for answering that poll question. Here are those results. Before we move on, as a reminder, in the related content widget, you'll find our Framework for a Successful Third-Party Risk Management Program ebook, which is a handy tool to assist with developing a successful third-party risk management program. Okay, Hillary, back to you.
Now we're going to discuss oversight and governance. So beyond those three lines, there has to be oversight and governance of the program. And this responsibility falls to senior leadership and the board of directors. Because no matter what happens in the organization, senior leadership is always accountable, and the board is on the hook to make sure that senior leadership is managing any issues effectively. But what does oversight and governance actually look like? Well, first and foremost, it's setting that tone from the top, which means that they're reinforcing that vendor management is a priority and the consideration of vendor risk is integrated into corporate strategy and business decisions. It also means that there are sufficient resources, including skilled and competent people, to do the job. It's approving the policy and having awareness and understanding of how much third-party risk there is across the organization and which vendors are critical to operations. Finally, when issues come their way, they make sure they're dealt with in an effective and timely manner. Then we have the board of directors. I realize that not every organization currently has their board of directors involved, and even though it's a regulatory requirement, if for some reason the board is not participating, just keep in mind that your senior management will need to absorb these responsibilities. So the board must ensure that senior management is prioritizing vendor risk management and integrating it into business. And just like senior management, they need to ensure that there are sufficient resources to effectively manage the work. So the board is also responsible for reviewing the results of any independent reviews, exams, etc., and reviewing the vendor management policies. They also should have a good understanding of which vendors are critical in the organization. Now we have external oversight, and this is essentially the regulators. It's important to know that there are many regulators across the financial services industry, the OCC, the FDIC, the SEC, the CFPB, a lot of alphabet soup there. But no matter what, it's important to understand that all of these regulators look at one another for best practices, and they're part of the FSIEC, which is the Federal Financial Institutions Examination Council. So they basically work across the board with very similar standards and requirements. Credit unions are specifically managed by the NCUA, which is the National Credit Union Administration. It's important to keep in mind that there are also state and regulators. For example, insurance is regulated at the state level. So what do regulators do? Well, they do a lot of things. Primarily, they're responsible for setting the requirements and guidelines that constitute what safe and sound business practices are for third-party risk management. That means compelling transparency and monitoring the decision-making on the part of the credit union. So are you synthesizing those requirements into your operational practices? They'll also conduct their audits and monitor the performance of the credit union. And if something is wrong, if they determine that there's an issue, they're responsible for carrying out some sort of enforcement action, such as making sure the institution complies with those requirements through fines or other financial penalties, or even revoking a license to operate if necessary.
So let's take a moment to look at the third-party risk management lifecycle. After all, this is really the meat and potatoes of any program that you might have and will represent where you're spending most of your time. Keep in mind that if you've seen this before and it was more of a circular fashion, we've pulled it into a more linear path to really help you understand where you are with any of your vendors at any given time and the activities that come next. The life cycle has been broken up into 3 distinct stages, which are onboarding, ongoing, and offboarding. The whole process is supported by governance, which includes oversight and accountability, documentation and reporting, and independent review. The onboarding stage is incredibly important because this is where we determine how we're going to treat that vendor throughout its life cycle. And while we can't touch on every piece and every activity today, we will focus a little bit on onboarding because it does determine how we react to those relationships throughout their lifetime. So the first thing is planning and risk assessment. Obviously, we have to plan for that relationship. We have to determine who the owner is, and we have to understand the risks that are associated with that product or service and therefore the vendor. Once we have our risk assessment completed, we should have a risk rating or a level, and we should know whether or not that vendor is considered critical. From that point, we determine how much due diligence we need to do to ensure that we can confirm the vendor's control environment. Once due diligence is completed, the contracting phase continues through execution. Once that vendor has an executed contract, they're technically on board. When you go through the ongoing stage, it's a constant and continuous look and review at how the vendor's performing, what their risk profile is, if you're getting the value of the relationship, and keeping all that due diligence information current and accurate. If everything is as it should be, you can go to a contract renewal when necessary. When the relationship needs to end, and all of them do at some point, you need to go through the offboarding stage, which includes the formal termination, the legal breaking of the contract or notification that you're not going to renew, and you'll have to have an exit plan to execute against. That exit plan really is the soup to nuts list of everything that needs to happen to bring that relationship down safely and soundly. That it can include transferring the service to a new vendor, closing it down, or bringing it in-house. Whatever it is, the exit plan should capture all the roles and responsibilities on both sides, both the vendor and your organization. And finally, when that's complete, you'll go to third-party risk management closure, which is the official closing that record down within your systems of records and properly archiving all the information and data so that you can access it when necessary for an audit or exam.
Our second poll question of the day is, when considering your third-party risk management program, which areas present the most challenges? A, engagement from senior leadership and the board. B, vendor owners or your first line participation and accountability. C, clear information regarding roles and responsibilities. D, having enough resources to execute third-party risk management effectively. E, none of the above. Or F, not sure. Hillary, we have another question here that I think we can go ahead and answer.
Great.
And that question is, what area should vendor management report to?
Well, in a lot of organizations, vendor management reports into a larger risk organization, such as enterprise risk or risk and compliance. But that's not to say that's where it needs to report in your organization. Every organization is different. There are different resources, divisions of labor, and how people report is really structured based on your individual credit union. So what's important to remember is that wherever third-party risk reports is that they have a good executive sponsor who can help communicate the importance of third-party risk and set a tone for the top. If you're buried into another department where third-party risk or vendor risk doesn't really seem to be a priority, it may be not the best alignment. But generally speaking, third-party risk or vendor risk should be part of a larger risk organization.
Thanks, Hillary. And as a reminder, if you wish to receive the CPE credit for today's session, you must answer all poll questions and be in attendance for the entire live session. As you're reviewing these results, I'd like to make you aware that you'll also find our third-party risk management lifecycle toolkit in the related content widget. This toolkit will provide an overview of the third-party risk management lifecycle that we briefly discussed a few moments ago, covering the stages in more detail. Okay, Hillary, I'll pass it back to you.
All right, so first things first. The most important part of your third-party risk management program is your third-party inventory. To have a third-party risk management program, you have to know who your third parties or your vendors are. So to start, you can get a list from your accounts payable of all the third parties that have been paid. From there, you'll need to sort out who will be included in your third-party risk management program, because not all third parties need to be included. Let's look at some types of third parties that are generally considered out of scope. The first would be payees. Payees are individuals or who've been issued a payment of some sort, but not for products or services. For example, someone who received a payment on a legal judgment, or someone who's being reimbursed for an approved expense. We can safely exclude them. Another type of payee category might be a sponsorship or a donation. For example, if you sponsor a Little League team or put an ad in the program of the High School Musical, that doesn't need to be included. Public utilities are another category you can safely exclude, as are any emergency services such as police and fire departments. You can exclude courts and taxing authorities, and third parties that offer services to your employees where your employee owns a direct relationship. So for example, if you offer a discount on a health club, but it's up to the employee to sign up and manage that relationship, you can safely exclude that as well. Now you remember in the life cycle, we had a stage, the onboarding stage where it said planning. Credit unions in particular have some very specific requirements during the planning step. And that's because the credit union model, unlike a typical bank, regards their customers as members, having a stake in the success of the credit union versus just being part of a transaction. And this is very different than traditional banks that have customers. Because of this, there are some very clear expectations around making sure that the credit union has really thought through that potential relationship with a vendor and understands how that vendor will benefit the members. This means having good financial projections and understandings of the cost, and your program should require some evidence of this consideration. So for example, a documented business case is a great way to meet this requirement. And when the costs are significant, having documented financial projections is strongly recommended. The next very important stage is your inherent risk and criticality assessment. Remember, all vendor relationships come with risk. And one of the very most important and first things we do is to understand what risk we're dealing with. So the inherent risk assessment helps you identify both the amounts and types of risk in any relationship, in any engagement. Inherent risk assessments are to be done internally, right? This is an internal process or document, and the vendor owner should be the one completing that risk assessment. After all, they know everything about the product and service, so they're the best person or individual to complete that activity. That inherent risk assessment should give you a risk rating or a risk level. Many times we just see high, moderate, or low. These risk ratings are the foundation of all other activities you're going to do through the life cycle. So it's really important to get this stage right, and it's important to make sure that every third-party engagement has a risk rating. Not only will that inherent risk assessment help you understand the risk present, but it will also help you determine if that vendor is critical to your credit union. So a really important part of inherent risk assessments is understanding and being able to identify the various types of risk that can be present in your vendor relationship. So let's go through a few of those right now. These are the most common ones. Depending on your organization, you may see different or additional types of risk. But let's start with strategic risk. This is really the risk that you take when you're a third-party vendor. Their actions, their strategies, their way of doing business is not compatible with your credit union. And that can manifest in a lot of different ways. But let's say that they are offering a ton of product and services. None of them seem related. That may indicate that they're not actually an expert, and so getting into a relationship with them may be contrary to your strategic goals. The next one is operational, and this is broadly defined as saying the risk is that we will have some sort of loss because of a third party's ineffective or failed processes, systems, people, whatever. Compliance risk is really when your third party doesn't comply with the laws and regulations, and when they don't follow your internal policies, business standards, or code of conduct. So moving on to other risks, information security. This is huge, and this is the risk that stems from your third-party vendor not having good security protocols or having vulnerabilities. We often hear about cyber risk resulting from missing or ineffective controls. So we can have cyber attacks and data breaches. We also have ransomware now, which is a biggie. Another way that information security risk happens is when your vendor uses your organization's data or your members' data in a way that is not permissible. We have financial and credit risk, and that's really what is the financial health of the vendor themselves. If they are not doing well financially, they may not have enough runway to last throughout the length of the contract. Then we have reputation, and this is really all the ways that a failure on the vendor's part can negatively impact your reputation, your brand, or your actual name. That can come from anything. It can come from poor customer service. It can come from multiple outages or data breaches or lawsuits or even regulatory actions. Just to dive in this a little bit more, we have an inherent risk questionnaire that should have specific questions that will identify the types and amounts of risk present in an engagement. So let's look at some examples of those inherent risk questions. So the first one would be, does this product or service in any way impact our members? That could be your reputation or compliance risk. Maybe you want to look at the sensitivity of the data being accessed, processed, transmitted, or stored by the vendor. So is it highly sensitive data? Is it confidential but moderately sensitive, or is there no data, or what they have is publicly available and it's not sensitive? Another question might be, is that vendor processing any financial transactions on your behalf? So do they have to be PCI, which is your credit card industry standard? Are they processing data or transactions? Another would be, is this a technology-related service that has to plug into our network, right? That can be information security risk. Or would a disruption in the service cause a material impact to our institution or our members? That is a criticality question that would help you determine that, yes, this impact is big and this vendor is probably considered critical to our organization. Now, we mentioned critical vendors, and it's really important that we take a moment to reinforce something for you here. And if you walk away with anything, please know this. Critical is not a risk rating. It's merely a designation or a group of vendors that are essential to your operations, because criticality speaks to business impact, where your risk rating is looking at the types and amounts of risk across that relationship. So another thing to keep in mind is that while many critical vendors are also high risk, not all high risk vendors are critical. So if we want to figure out who a critical vendor is, we use 3 really great questions, and they work most of the time. The first one would be, would a sudden loss of this third party cause significant disruption to our business? This is significant. It means enterprise-wide, like could close the doors. So make sure you're clear on what that means for your organization. The next one would be, would the sudden loss of this vendor, them going offline, negatively impact our members? Well, this is a biggie because it's not just operational issues there, but it's also compliance issues. So for example, a payment processing system. Your members need to make a payment. If they can't do that, there could be legal or compliance issues. So that could be a critical vendor. The last question is, if the service is disrupted, would there be a negative impact on our operations if the time to restore a service took more than 24 hours? So if the answer to any of these questions is yes, you have a critical vendor.
Our next poll question is, does your credit union have policy, program, and procedures documents as part of your third-party risk management? A, yes, we have all three. B, no, we don't have any documentation. C, somewhat, we have some of the documents, but not all three. D, we have a different set of governance documents. Or E, you're not sure. And Hillary, let's go ahead and answer another question from the audience. And that question is, do we have to have a separate vendor management policy, or is it okay to be a section in another policy?
You know, this is a question we get a lot because initially when third-party risk management or vendor risk management programs start out, they might be a subsection in another policy, like your IT policy or your compliance policy. But in truth, vendor risk management or third-party risk management really does need and deserves its own policy, because a well-written policy will be probably about 10 to 12 pages long on average. That's a lot of information to stick into another policy. Also, the regulators really want to see that you have prioritized it, and therefore giving vendor risk management its own policy really makes a statement about its importance and where it belongs in your organization.
Okay, great. And it looks like we have time to answer one more question. And that question is, do we have to have a program document?
So program documents are not mandated by any regulator, but let me tell you why they're so important. The first part of the program or the governance documents is really all about your policy. It's giving you those rules, tools, it's really saying this is how we meet those regulatory requirements, because these are the rules we have set up to address those regulatory requirements. But if you go about putting in all of the ways you meet those regulatory requirements, you'll end up with a policy that's 100 pages long. You don't want to do that. Program documents are really meant to be an internal document that really instructs all the stakeholders not only on the various processes, but all the roles and responsibilities, the timing, the inputs, the outputs, all the necessary information that they might need to know to execute against those requirements. And these documents are not easy to put together. They take a lot of time and they can be very lengthy, but once you have one, they are invaluable. And they're a great way to help your senior leadership, for example, understand not only the complexity, but all the moving parts and all the ways that third-party risk management needs to be addressed from different areas across the organization. So while you don't have to have one, I absolutely recommend it.
Okay, here are those results. Thanks again, everyone, for taking the time to answer that poll. Before we move on, just a reminder that we've provided our Developing Your Third-Party Risk Management Program document checklist also in the related content widget. It provides helpful tips for developing your program document. Hillary will be discussing governance documents in our next slide. Take it away, Hillary.
Now moving on to another important part of your program would be your governance documentation. Keep in mind that per regulatory guidance, the only thing that's actually required is a well-written policy that defines the rules, boundaries, and guidelines for third-party risk management at your organization, right? So your policy is usually a shorter document that defines what's necessary to meet those guidelines or expected standards. So these are basically the rules. Your program document, on the other hand, not mandatory but highly recommended, and some people call this a standard operating procedure. This is basically like your playbook. It is the soup to nuts version of everything you need to do throughout the life cycle, the roles, responsibilities, the inputs, the outputs, the timing, any go or no-go decisions. This is all in your program document, and it's basically the description of all those processes that we need to undertake to meet those requirements. Then we get down to procedures, and procedures really represent the biggest part of documentation because there's often a lot of them, and they tend to be specific to a specific process and a department. But these are the step-by-step instructions that are required to execute those processes. So again, your policy, mandatory, doesn't have to be the biggest document, but has to be well written, and it needs to be reviewed and approved by senior leadership in the board. Then you have your program document and your procedures. We've included this slide just to give you a little bit more context and a different way of looking at those three governance documents. Remember, your policy details the rules, principles, and guidelines used to manage third-party risk at your organization. Your program document lays out all of the processes required to meet those requirements. And your procedures are the step-by-step instructions necessary to execute the processes. So we've talked about the board and senior leadership having accountability and responsibility. But how do we, as a third-party risk management or vendor risk management professionals, help them achieve those goals? How do we ensure that third-party risk management has a right level of visibility and consideration at the credit union? How do we ensure we're going to get action? The key lies in the information presented to the board and senior management, the timing of that information, and what you need them to do with that information. And this is often the most difficult part for many third-party risk management programs. So let's talk about reporting. All right, first things first. These are general guidelines for reporting to the most senior levels of your organization, and they can be applied to any information presented to the board or senior leadership, whether it's third-party risk management related or not. The number one rule here is that data has to be accurate. That means that the data is reviewed, ideally by more than one person, and tested. So are the inputs correct? Are the calculations correct? Are you reporting on the right data dimension? That one is a biggie. So if you're just putting numbers into a report that do not support the agreed upon metrics or provide enough insight, that can be a problem. And I probably don't have to say this, but I will. Always base your information on facts, not opinions. Timely. You can't expect anyone to have a favorable reaction to old data, especially if that reporting is used to bring attention to an issue. If you knew there was a problem 6 months ago and it's just coming to their attention now, you'll probably have some uncomfortable explaining to do. The best way to avoid that situation is to keep a regular reporting cadence. Any issues or problems that need addressing should be presented to senior leadership first before ever showing up on a board report. So we're going to spend a minute talking about two really important elements of your reporting, and that is to make sure it's easily digestible and accessible. And what do we mean by easily digestible? That means providing the most important information using the least amount of data points. Why? Because even in organizations that have really streamlined board reporting, those reporting packages are hundreds of pages long. So you don't want to send 20 pages of data, and just don't send a bunch of numbers without any meaning or context. If you want to show how many critical and high-risk vendors you have, because that's where the bulk of your work is, don't send a report that says we have 20 critical and 48 high vendors. That's not meaningful data. That's just counting something. What is meaningful? How about we now have 20 critical vendors, a 15% increase over last quarter, and a 30% increase over last year. Those numbers can be easily understood. The critical population is growing, and those numbers could be potentially used to support a request for more resources. So remember, your use of data and intent for that data should tell a story, and it's important because data can only serve two purposes. The first is to provide information, because there is a need to keep the board and senior leadership informed, or to drive action. The information is only relevant if it has a context. Does the board care how many high-risk vendors you have? Yes and no. They won't care if you just put a number on the report. Yes, they will care if relative stability in vendor population is one of the numbers you use to establish your program health. When you have an upper and a lower limit set for vendor population, for example, they can easily look at that data and say, yes, that element of the program is operating within the control. Or no, we've exceeded the number of vendors that we can effectively support with our current FTE ratio, and some action is necessary. So make sure that you're providing the data and the data story and the implications of any variations of those data sets, because you always have to articulate what the data means and what actions are recommended as a result of that information. Always think about the data as signposts for leadership. Does it tell them where they are? Does it show them the way to go? That is the secret to good reporting. Another principle of good reporting is noting the data source and who is responsible for that data. Should they need clarification or more data, that's very important. Those sources, by the way, should be really easy to access, because if your report is cobbled together from multiple data sources with too many complex calculations and formulas, that is not accessible. So we've covered an awful lot today, but yet we've barely scratched the surface. So let me give you some best practices to improve your third-party risk management program if you have one already. The first one is focus on the fundamentals. Get the basics right before you go into complex improvement plans, because it just won't work unless you have your basics correct. Make sure you identify your third parties and determine who is in scope. If every single third-party entity, whether they're a vendor or not, goes through the program, it's going to create a lot of confusion. So make sure to get that right. Look at your governance documents and make sure that they address the specific purpose for which they're intended. So our policy document should not have a bunch of processes and procedures in it. If it does, we need to rethink that. Go back to the drawing board and get it right. Make sure you're aligning to the third-party risk management lifecycle. There's virtually no other way to get this done effectively without it. Ensure that your risk assessment is clear enough to identify the highest risk and to help you clarify the difference between what is critical, our business impact, versus the risk. Of course, we want to scope due diligence appropriately, because not one size fits all. We want to do less due diligence, maybe less robust due diligence for those lower risk engagements, and we want to really throw it all in for those critical and high risk engagements. We need to keep that vendor monitoring continuous. That's performance monitoring and risk monitoring. We can't just pick it up once a year and say that's good enough. We need to do it year-round. To do that, stick to a review schedule, stick to a performance management schedule. If you are behind with any of these activities, consider outsourcing it. There are many third-party risk management firms that can help you get caught up, or even permanently take over portions of your process that may be hard for you to get done. And stay informed about the regulatory environment and what's going on. All right, here's some common mistakes to avoid. I'm just going to go through a few of these to really emphasize the point that building your program, if you don't understand the regulatory requirements, you don't understand what's normal and specific for your industry, can be a really big problem. So take the time out to really get educated before you go off and try and create something. The next thing is making sure that your policies are clear and enforceable. Without them, you don't really have a leg to stand on. So that's something that needs to be taken into consideration really at the beginning. We want to always make sure that roles and responsibilities are clearly defined and that everyone understands what their role and responsibility is. Stakeholders across the organizations may have different ideas about it, so we want to make sure it's really clear. We also want to make sure that we are not substituting that periodic risk review for ongoing monitoring. Picking that up once a year and saying, how did the vendor perform, is not enough. It's something we need to do year-round. And then finally, not managing third-party performance can be a huge issue, so please don't make that mistake. So with that, we've wrapped up our session today, and I will turn it back over to Jessie.
Great, thanks so much, Hillary. Before we dive into more questions and answers, I want to thank everyone for attending. I would also like to thank Hillary for her time in sharing some really important information. On your screen now, you will see our upcoming webinars, How to Review Your Vendor's Financial Health on May 17th, and Managing Risk Throughout the Vendor and Supplier Lifecycle on May 31st. We hope you will be able to join us for those sessions. A link to register for those sessions is in your copy of today's presentation slides and also in the related content widget. Let's now go ahead and answer some more questions that have come in during this session.